Coming up on today's episode.
With any property investment journey, yes, our first one and our second one and our third one, maybe we can wing it a little bit. But once you get past that, like third, fourth, fifth, 10th investment property, cash flows become more important than even how we get the money, because you're usually working with a broker then, because it's not necessarily borrowing capacity problems, it's how you manage your cash flow. Because borrowing capacity, I firmly believe your borrowing capacity cap is a furphy. There is no such thing as a borrowing capacity cap. It's all about what you're willing to do and how you manage your cash flows and how you generate your deposit.
Dodgy advice and bad decisions can cost you big in real estate. We're here to make sure that that doesn't happen. Welcome to the No BS Real Estate Podcast. I'm your host, Jo Agresta, and it's time to take control of your property journey together.
Welcome back, everyone, to the No BS Real Estate Podcast, your listening how-to guide to the Australian property and finance market. I'm your host, Jo Agresta. And if you've been feeling overwhelmed by the mortgage process, confused by pre-approval requirements, or just frustrated with shifting interest rates and lender hoops, then this episode is going to give you the clarity you've been craving. Or maybe you've been wondering how to get your foot in the door as a first-time buyer, how to build long-term investment lending strategies, or what actually makes one mortgage broker better than the other. Well, today's guest is here to unpack all of that and more. I'm joined by Aaron Whybrow, founder of Strategic Mortgage Brokers. Aaron doesn't just help clients get a loan. He helps them build strategy. Whether you're buying your first home, expanding your property portfolio, or you just want someone to cut through the BS and explain things in plain English, Aaron's your guy. Aaron, welcome to the show.
Oh, it's good to be here, Jo. Thank you for having me.
Of course. I'm so keen to unpack, we've had a couple of catch-ups now, and everything that we've talked about, I'm like, oh, this guy's got to be on there. We've got to unpack his brain a little bit because I think our listeners will learn a lot from you.
No, it's good. It's a fun time in the property and finance market.
Oh, you're not wrong, especially because you're New South Wales based. So like I said to you, we have a lot of Victorian based guests. So I'm so keen to see what's happening in our neighbouring state and see how you're kind of seeing the market with your clients at the moment. So,
Absolutely.
Well, Aaron, I like to start, this show off with a bit of an icebreaker, and because real estate can be really dry, so let's just have a bit of fun with it.
Let's do it.
Okay, so the first thing I'm going to do is I'm going to throw a few finance and mortgage words your way. I just want you to give your first reaction in a couple of words, or one word, right? So no overthinking, just the first thing that comes to mind.
No worries.
All right, let's go. Interest only.
Cash flow.
Offsets.
Saving money.
Fixed versus variable.
Stable repayment or flexibility.
Servicing.
Magical calculators of the bank.
Equity.
Untapped resource.
Lender's mortgage insurance.
Just the cost of doing business.
Love it. And refinancing.
Make everything cheaper again.
Portfolio.
The foundation of a good financial freedom life. I know it's one word, but I'm going. I'm riffing here.
Yeah, do it. And last two, redraw.
Redraw. Good for owner-occupieds, not good for investors.
Okay, Beyonce.
Music.
Love it. That was awesome. I love doing that little segment because I feel like we often don't stop and think about what we actually think about those terms. But you have really good answers.
Oh, live and breathe this stuff. It's great.
I love it, especially the equity one. That's good. Aaron, tell us, I want to launch into your journey. I think that's the natural place to start. How did you get into mortgage broking and what led you, into launching Strategic Mortgage Brokers?
Yeah, so I wasn't always a broker. Don't have a background in banking, don't have a background in finance at all. I actually have a background in healthcare. So I was an intensive care nurse for pediatrics and adults in the day. And I also love to do medical motorsports, so running around the tracks at Mount Panorama and the V8 supercars, which was fantastic. And then I got into business area. So I did a master's in business and I was selling medical equipment. So for multinational companies for medical devices and healthcare again. And then in my master's of business, I got a little bit of a bug on the financial side. I went through a bit of a crushing event, I suppose. So most of my career changes have been through a crushing event, which is if you've ever thought of a grape, what's the best, highest form of a grape? It's actually when it gets crushed and turned into wine. So it's actually, then it's nice and delicious from there. So from my crushing event, I was actually had a financial incident where I was frauded some money and things. So I vowed that wouldn't happen ever again. I also needed some extra money at the time as a bit of a side hustle, and mortgage broking seemed to give me that edge to be able to get myself out of trouble and make sure that I was able to get everyone else that was in that situation out of trouble as well. And now we are rocking and rolling and really focused on how we can make everyone's life a bit better with having property, so that anything that throws at that area, whether it's crises, whether you need to have an extra bit of money, healthcare, divorce, whatever it is, property can help you get out of those situations, and just having some money is better than not.
Thank you so much for sharing that, your personal side of the story. I think a lot of great business has always come from having experienced the pain point, one way or another. So, I'm sorry that you had a crushing event, but I love your analogy for, it comes wine and you rise up, and you've done exactly that.
Absolutely. Yeah.
Oh, that's incredible. And, your brand talks a lot about, it's actually in your brand name, strategic lending. What does that actually mean for clients in real terms?
Yeah. So we, although we do a lot of transactions, so we do a lot of applications, we put those in to get the lending in the right area for people's wishes and desires. But what we want to dig into is the goals that relate to those transactions. So it's like, if I do this, what's going to happen next? All right. So I don't want to just do a transaction. I want to look at how it relates to the overall goal of a client. So if you have a goal of doing 3 properties, or you have a goal of passive income, or a goal of just the number of properties, or the value of properties, or you want to get the debt and then pay it down, you might be young, you might be old. We need to bring the tools, tips and tricks to be able to manage everything from what you're going to do next. So if we go to, we put it in real terms, if you wanted CBA as your lender, but you needed 5 properties, is CBA the right one for you right now, or is it ANZ? How does your employment relate to that? What's the forecast from self-employed, being that we're at the tail end of the financial year? How does that relate to the next thing? So what we want to do is understand the strategy that fits to your goal, and then do the transaction versus just do the transaction and then get stuck.
So I really like that. I think there's a lot of the professionals out there that I think when you go to the bigger corporates, with mortgage companies in that case, not naming names, you do find that it is very transactional. It's not really goals focused. And I think that's where a lot of people get into trouble. It's like they get the access to their home loan and they're on their way. And then maybe they get a check in, 6 months in saying, do you want to refinance or do you want to look at your options, but not really setting them up from the start. So I like that that's the edge that you have, because I haven't often heard a lot of people talk about the strategy and how important it is. So, it's excellent for the listeners tuning in who are like, oh, I didn't really think of it like that. I would think that I want this house, get me the house and get me the loan.
Yeah, you've got to have joy in life as well. So buying your own home or having an emotional connection to a house, whether it's near a school or it's just the right pool in the backyard and things like, if your own home has a lot of joy in it, go for it. Because we can sort out goals and stuff after a decision that is an emotional and a choice, because we've got to enjoy life as well. But when it comes to investments, we've got to enjoy now the numbers instead of the color of the door or how many rooms it's got.
Color of the door, I like that.
Yeah.
And it's true. It's kind of, it leads into this, my next kind of questions, like breaking down the mortgage process. And obviously we have 2 different approaches when we're looking at investment and we're looking at, home ownership. So for someone, let's take a scenario, for someone that's completely new to the home loan process, and they're looking for an owner-occupied home, what does a smooth mortgage journey actually look like when they're working with you?
Yeah, so just to outline how, if you started afresh engaging with us, you'd get a phone call with me, being that I can give a lot more value up front, and it gives you a lot of ideas to understand and extract out and how those goals relate to the mortgage. Once we've had that call and we've gone through some basic numbers, we understand that we're going to validate both of our time to go forward. Then I'm going to be using my team to help you faster, basically. So I've got a team. So when you engage me, Aaron, you're engaging the whole company, basically. You have more than one person on the file at each time for financial call-offs and things like that. But then we're going through the financial fact find. We're helping you walk through that. We're helping you find all the supporting documents, because there are like the deep dark recesses of getting the right transactions and things that are valid for the bank, through to even collaboration with your accountant. If you're self-employed and you're just a specialist in your area, getting the tax returns or even having a look at that can be quite daunting. So we're collaborating with accountants. We're getting the right documents. We're bringing we're like a bit of a coordination service of getting everything together to get the right presentation and the right foot forward with the bank. We're spending the time on the phone to the bank for the hours of waiting and understanding where your file is up to. We're escalating that for you. You're talking to us, and any stress, strain, or anything that's going through, we're the ones that are coming to you to deal with that and understand it and push you forward. So we're walking through from an initial call with me through to the team, through the application. And then once your settlement's happened, that's where if you're doing your first journey with a first property or a next property, we believe settlement's where our work actually really begins, because that's where we want to go to the second, third, fourth, or how else can we affect your life from wherever you're investing. If you're going to buy a business or become self-employed or have a promotion or want that next property, how does that relate to the lending so you can go further?
I think that's great. Like what you described there, I like how you said that really begins from settlement, because I think often where homeowners get really excited is how do you get the asset? Then you get the asset, but there's not really much talk about how to manage it. Not just from a financial aspect, but, from actually maintenance perspective, and, when should you do certain things, or how do you earn money off what you've just purchased?
Yeah. And there's all those little things like, did the property manager have your right bank account number, and did the mortgage come out before you actually were able to sort that out with the property manager? So there's all those little bits and pieces that where your expertise comes in, whether you're doing a little bit of a paint job or you're doing some stuff to the house. What we do forget about sometimes, and a lot of the finance industry does, is that if you're buying an established house and say the rent was lower, and then a couple of months after you bought the house, you can then release the property for back to market rate of rent, that can change the whole aspect. So we might have had to go to a loan beforehand that had to accommodate a lower rate of rent, which may not be the long-term loan for you going forward. So that when the rent goes back up after settlement, that's going to help us go after the next property, right? The other thing is that it can be a bit daunting, and I was described the period of time at settlement being the wobble period. Like, where's my internet banking login? So from a financial point of view, where's the internet banking login? Have we got our first repayment organized? Have we got the offsets linked to the right thing? Have we got all that sort of stuff? In addition, do we have the keys and the tenant and the property manager? Like, it's a bit of a wobble period at that time. So I feel that if we can take a bit of that pressure off, even to the point, like I like to advocate to the clients that you have an offset account that's separated from everything for your property management stuff. Because if you can manage the cash flows right, and you can manage how the conversation is with the agents and things, that whole stigma out there of investing in property and it's too hard and it's not going the right way or everything's going bad, if we can get rid of that, we can go for more properties and actually change our wealth trajectory.
I really enjoyed how you kind of phrased that, because often there is this stigma, right? Especially with investment properties and what the media kind of publishes talking about. Everyone's getting out of there, selling their rental properties because interest rates, because this, because that, or bad tenants. And it's like, I feel like I interviewed a mortgage broker, a property manager yesterday, and she had such an interesting perspective. She said 98% of my portfolio, my rentals, are great tenants. I have no issues. She goes, it's maybe 2% where they're not even that bad. It's just people that, I have rent payment issues. She goes, so it doesn't represent the majority of what I'm seeing. Personally.
I think there's two aspects on that one. It's like the great Australian dream to have property, but when you have property, we're going to really attack you.
Yeah, that's right.
Right. So it's just a conundrum of conundrums right there. But then when you dig into it, there's a whole range of things that the property investor does, like property tax, rental assistance and stuff is all funded by some of that sort of stamp duty and things like that as well. But with tenants, I think we're all human, right? Like, I've had tenants break the back garage door in my property portfolio. I had a tenant like dump the keys on the bench, and I had like rubbish everywhere. I've had tenants not pay. I've had tenants that are great. And sometimes we talk about all the disastrous stuff. We just don't talk about the good stuff. I've got a tenant that's in the property where I'm holding my office at the moment, and we get along like a house on fire. He needs his deliveries while he's at work. They get delivered to the office here for me. So we get along like a house on fire. But what I need everyone to think about with property investment is that it'll happen, right? Yeah. I think it's normal. Sometimes if you normalize that someone will break a window or dump some rubbish or there's a tenant change, if we think that that's normal, we can overcome it with insurances, and if we're going to do a little bit of a reno to make it better for a tenant, we can deal with some finance and things as well. So I think if we just normalize it, I think we're all good. We're good to go.
I think that's true, because if you look at like the rental rights overseas, like Europe, for example, the rental rights are huge. Like when you compare it to Australia, like I know, like I've got an Italian background, so my family members, majority of Europe rent in Italy, I have to say. They're all renting. It's not normal. It's not the dream to buy a house, and it's very rare that you get someone who actually purchases property especially in the southern region. And what I find is they have a lot of rights. So they find it weird when I say to them, no, it's like you can do 3-month lease, 6-month lease. They go, are you joking? If I don't get offered 5 years, what am I going to do? The rental game's completely different. So their leasing is like very long term. They kind of get scared that we only offer maybe 3 12-month leases at a time. They're like, that's crazy. They would never do it. And I'm like, there you go. So I think realizing the fact that like we make mistakes in our own home, right? It's like I've broken windows before by accident, kicked a ball. Like as a kid, I've kicked balls into my parents' wall, and I'm like, oh crap, I've busted the wall. These things are going to happen with tenants. I really I can appreciate that view of normalizing the fact that they're human. They're going to go through things like we do. We're going to not pay, rent 1 week. It happens. As long as it's not something where they're intentionally damaging this home all the time, that's a different issue. But these little things that happen, you can't tarnish their whole name because of 1 or 2 incidents. You
know how you can get over it from a financial point of view, and I am relating a little bit more back to lending and finance there for that, is that you can't empty your bank account to buy an investment property. You've got to have some money left after the transaction. And when you have money left after the transaction, you can deal with the mortgage payment first off with the property manager sorting out your BSB and account number. You can deal with a missed payment of rent, not for the long term, but you can deal with that stuff. So if we're able to have a buffer, not only on our personal healthcare, own home, kids, family life that throws at us, that number is whatever you decide it to be. But with the properties, if we've got the good cash flows from the due diligence from buyers agents and property partners, and we know what the repayments are, we know how to calculate what's going to be negative during the year, what's going to be positive during the year, what are you going to feel comfortable with having a buffer on this property. And with any property investment journey, yes, our first one and our second one and our third one, maybe we can wing it a little bit. But once you get past that, like 3rd, 4th, 5th, 10th investment property, cash flows become more important than even how we get the money, because you're usually working with a broker then, because it's not necessarily borrowing capacity problems, it's how you manage your cash flow. Because borrowing capacity, I firmly believe your borrowing capacity cap is a furphy. There is no such thing as a borrowing capacity cap. It's all about what you're willing to do and how you manage your cash flows and how you generate your deposits. Those are the 3 top things, is what you're willing to do, generating deposits and managing cash flow. If you've got that down pat, how many properties do you want?
I love that. And it's very motivational. It's like when you break it down that way, it seems much simpler. And it kind of leads me into the question of, how hard is it, right? If we go back to this mortgage journey, to get pre-approved in today's market, and what should, buyers or investors realistically have in order before they, do their application with you?
Yeah, it's interesting how many people say, I was told to do this before I talked to you, or I was told to do this before that, or no, it's not going to work, can't do it. The biggest thing is with the lenders these days, with the interest rates where they are, yes, we're seeing them start to come down since we're in April 2025. We're seeing them come down a little bit, not as fast as anyone would like, or even I would like. I'd love it a bit more off the rate. That'd be great. But how hard is it? Once you can meet the income benchmarks of the chosen lender, the lender policy is quite flexible. Owner-occupier properties for years and years, the lenders would throw 95% at you. They would put the mortgage insurance on top. We've got all the incentives and things that the governments have got in the relevant states around Australia, even to the point of nearly giving you the whole deposit away, which is really fascinating in Queensland and Northern Territory and things like that. But with once you hit the income benchmark, like we're now getting 95% lending with the major banks on investors. Right. So the old furphy of 90% that's been for years and years is now starting to change. There's some nuances around needing principal and interest once you go over 90%, and lenders mortgage insurance is still not the nicest once you get at that level. It's okay for a cost of business, but it can get a little pinchy. Plus the interest rate usually goes up when we borrow more than 80%. But once we meet the income benchmarks, the banks want to do business with you. So it's really interesting. It can be a challenge to jump over the income benchmarks, but once you do, like, the doors are open.
Yeah, that's interesting. I haven't really heard someone put it that way. It's like once you overcome that hurdle, and you do have like your LMI and things like that sometimes, throw you off or make it frustrating for some home buyers. I think in particular in the owner occupancy space.
The first time's always the hardest. You've probably experienced it. Lots of people, clients of ours have experienced. Once we get over the first property, like, we can do a few valuations, flick a few buttons, get that magical servicing calculator out. As you mentioned, servicing, I think that's the most magical calculator you can find. I don't know who puts whatever over those Excel spreadsheets of the banks, but anyway, we have to understand it and which ones we go to. But that once we've got a property, we can do a revalue, we can wait a bit of time, let it do its thing, and then we're off and running again with another deposit. And it's just really getting started. If you make a commitment to get started, like, get your targets. One of the things, income is one, but the deposit's the other one that gets a bit challenging. So from an income point of view, casual is still a little challenging. You've got to be in your job for 6 months. Permanent, part-time, full-time is quite straightforward. Business, if you're contemplating doing a business, the tip I'd say is open your ABM as quickly as you can. Keep your job as long as you can. If you get all the borrowing done and all that sort of stuff, then. But then you can do 1 year's financials. You can do wages as a business owner. You can look at 2 years, and we can look at what's going to happen for 2025's tax year. We can do a lot of things with income, but the deposit is that thing that can trap people up. And if we don't know how much we need as a deposit, we're not going to be able to get there. I've talked to many first-time buyers, many first-time investors, and they just need to know what the deposit is. Yeah, and I can tell you, they tell me their savings rate. I tell them what the deposit is. We calculate the timing, and I can tell you they have the timing. And once people know what the target is, and it's say that it's going to take 12 months, it'll take 6. If it's going to take 6, it'll take 3, because people get motivated when they know what they're going after.
It's so true, because I think a lot of the time we're told traditionally, and I think this comes from years of like learning from our parents who have done this, 20 odd years ago, and they're like, you've got to save 20%. And you're like, 20% in this market is hard. It's like, in some cases, if you want something in the 800,000 range, that's a long time, especially on a single wage. It's like, I'm not going to save 20% for another 5 years. And by that time, that 20% is not buying the same value of property that you were initially chasing. I like that for anyone listening, and for our home buyers who are thinking, or first-time investors going, well, what do I do about this? That's so realistic. Just know what the deposit is. What is that sweet spot that you need to get to? Chase that goal instead, other than just following on what I think history tells us, 20%, 10%, all these factors. I'd love your take on that. Like, what is that deposit range?
So the deposit range, I think there's two aspects of what you're saying there in regards to spinning your wheels. What's 5% today is 2% tomorrow. What's 10% today goes to 5% tomorrow. What's 20% today goes to 10% tomorrow, depending where you are in your savings journey for that first one. The take on how much do you need for an investment property? Well, most buyers I'm seeing in the entry range is usually between that 400, 600 area, maybe the 400 to 800 area as we progress forward in time, because a lot of people are doing this. A lot of people, the market's changing. We've got all the factors that relate to the increasing in property prices. But we're looking at, if you can get at least 10% with if you wanted to go a bit more aggressive at the 95% lending. If you are going for a 90% lend where we can get a little bit more balance on the mortgage insurance, a bit more balance on the interest rate, probably around that 14-15% mark is always a good starting point, because then you can accommodate stamp duties, we can accommodate the mortgage insurance, we can get a better rate, all that stuff. But we can manage with anywhere between that 7 to 15% mark of a desired property. We have to take into account other things like what's the rental income, because that increases your borrowing capacity over time. So a lot of whether it's a 4% yield or a 7 or 8, depending on where you're buying what type of property, that all comes into the picture too. What's the opportunity in front of you? Give you an example of a client of mine. They came to us, they wanted to buy a block of land to build a property on. The block of land was sold for $750,000 in 2000, and we did this in 2024. So 2023, the previous owners bought the block of land for $750,000. The contract that they were able to negotiate and execute on was for $600,000. The motivation of the client changed because of that gap, right? So we were able to take a higher interest rate. We had to do it faster. We had to do a different type of loans. The savings rate, what I'm saying is the savings rate can, and our goals of property investment change to what is presented in front of us as well, and what we are trying to target. Like an opportunity, a goal, those things have to mishmash together. I
think this highlights also the importance of working with, those property professionals like a buyer's agent or advocate in this case, because I'd imagine that, I know for myself, I work closely with a lot of brokers when I've done when I used to do buyer's advocacy. I worked with the mortgage brokers a lot because I had to tee it all up and say, financially, does this work? Like, you tell me the financials, I'll tell you about the opportunity, and you tell me if it works. And I think that when you're going into this investment journey, those two professions really going to be the hero of whether this property is a good asset or a bad asset to manage. So I think a lot of people, that tune into this podcast, it's all about educating you on who do you get in your corner to be set up for success, rather than taking the route of I'll do it myself and I'll just pick this type of assets, usually an apartment because they're cheap, and then you don't make your money off it.
Unless you own the whole building. I'm not sure how many people own the whole building. I'd love to own a whole building of a big thing. That'd be great. But with what you're saying there is, yes, you need that high level collaboration, and then you mix in self-employed, and we need the accountant as well. But to be able to get opportunities, you need to be prepared. We all have the good old saying that property investment's just a game of finance with a few properties put in there. It's probably more of the sequence. Get your finances in order, and then you can take up the opportunities pretty quick. If you have a deposit and a pre-approval, that's the dream of a buyer's agent. And also a strong position of negotiation.
True. That's so true, because I know the negotiation side for us is everything. That's basically where we get to flex. Like, apart from picking the opportunity and the asset type, it's the negotiation of, can we save the money? Can we do this? Can we do that? And how do we get there? It's huge.
You've probably seen it before, where there's a handful of buyers after the property that you're trying to negotiate on, right? And your buyer may be the one that gets it at the lower price than the other bidders because of the terms and conditions you're able to put in there. Like, I'm able to leave the tenant in there for a bit longer past settlement to help out, whether it's for an old lady going into a nursing home, which was one of my properties. We were able to let that happen so they could move the money around and get to the right outcome, so that we could help from a human aspect as well as an investment aspect. Then you've got like settlement terms. So if you can get the speed to money, that's money still talks, right? Speed to money helps, and property is one of those really hard assets, right? So it's hard to get in and hard to get out. We just talked about the deposits and the borrowing capacity and all that stuff. So it's hard to get in. It's also hard to get out.
Yeah, it is, because there's a lot involved when you exit a home, especially if you're looking at investments, like when you have to sell, go through that journey. And then you want to use it to buy something else. Like, it's a huge mental tax on top of confusing if you don't have the right people in your corner.
That's right. But also, because it's hard, that's why it's a good asset.
That's right. Yeah. Well, it doesn't come easy. If it's something that's going to return you the right, it's going to put you in a better financial position. It's not always going to be easy. It's not like buying, clothes off the rack, or, talking to someone for 2 seconds about the opportunity.
I always describe it as one of the last hurrahs of delayed gratification is property investment.
Yeah, I literally did this in a TikTok the other day. I literally said, people always start with the asset first, right? So it's like when I look at home buyers, they always begin the journey, mentally they make the decision if they've got a partner or they buy themselves. They go, you know what, I've got enough money, I think I want to buy a home. They don't start with finance. They start with the asset and they go on realestate.com and they start going to inspections. And then they kind of find, oh crap, I actually don't know what I need and I don't know if I can afford it. Then they reverse engineer to try and buy that asset that they found first. And I'm like, property's the reward for all that work. The property is the last thing you do because you're set up to get there. So if you start treating it that way, it'll be much more rewarding than starting with the property and then saying this process is so crap or so confusing. But it's like, no, you've started in the wrong spot. That's why it's confusing. That's why you've made it worse.
Yeah. So in life today, we could be a couple of days from our pay run, right? Have next to nothing in our bank account. We can nick down to the Nike or ASIC store because our gym shoes have just gone nuts and we have to go the next day before we get paid, right? Keep that routine, keep that workout going. We can buy it with nothing in our bank account. We can just tap Afterpay, away we go, or get that sorted out. But with property, we can't do that. We could buy a property at 500 grand and we've got like 20, 30 grand of stamp duty. We need it to rise up by 30 grand before we even think that it's got a return on it, right? So and also that preparation thing is another one about the delayed gratification. Like most of the top investors that I work with multiple properties took probably 2, 3, 4, 5 years of preparation of their financials in the right spot, whether they're building equity in a home, whether they are just building up deposits, whether they're getting a career right, all that sort of stuff. Because when we get to execution, we see it all the time. A lot of people can execute on properties in their 40s quite quickly because their income's probably stable with career and stuff. They can execute probably in 30 months, half a dozen properties pretty quickly. But if they didn't do the reps beforehand, they wouldn't be able to execute quickly. So did that person that bought, say, $9 million worth of property in 5 years, did it take 5 years or did it take 10 years before that? So did it take 15 or did it take 10? No one sees what they did beforehand. We just sometimes in Australia like to have property and then we'll just criticize the people that actually have it.
It's true. And look, I want people to kind of walk away, a bit more inspired today. And I think this episode's interesting because we're talking a lot about this prep work and this, don't see it as this quick transaction that's going to happen overnight. Sometimes it doesn't. Like I know the state average for finding an owner occupancy home is 9 months. I've got a different philosophy that you can find your home if you've got the right professionals in place beforehand. What you do leading up to buying a home, like the time on market can be drastically reduced. Like we can achieve that in 6 weeks or less. And that's because you've done the grit work to get to this point. If you come at the very beginning where you say, I have no savings, I'm just interested in starting, then this is an episode that's going to actually allow someone to go, okay, well, what's involved? And like you said, 2 years of planning, sometimes 5 years, 10 years of planning or getting your personal situation correct is crucial to be able to activate these next steps. So I think people in their young, like in their 20s, who are just starting out, who are like, oh, I'll do this job for a bit, then I'll do this job for a bit. They might have a different opinion if their goal is to own a home early or is to start an investment portfolio, in their early 20s.
So I would expand on that one is that speed can happen as well. Once you're prepared financially, speed can happen. And we also need to be thinking about where we invest too. So we've had two different types of people come to us. We've had people come that are younger and they're able to rely on, say, the bank and mum and dad to help them with their investment properties, which is a big trend we're seeing at the moment, through to the people that are a bit older. They've been working for a while. They may not have too much savings outside in their own name or anything, where they've chosen the strategy of self-managed super funds. And we've seen people like, we had one client that bought 3 properties in their super fund within 6 months. We've had people buy 4 properties at once, or 8. I think it was last year we had someone buy a whole unit block of 8 all at once with 3 different lenders. So it's not that it's impossible to go fast either. We just got to, if we meet that income benchmark, we've got the deposit or equity from somewhere, we've got the cash flows right, we can execute on a whole range of things that we didn't think were possible with the right team. And you're 100% on the right team.
100%. I couldn't agree more. And, it leads me into like this SMSF. So for those listening, self-managed super fund. There's a lot of people that are more, aware that they can buy through their super fund. I think I would love your opinion on how do you actually see that play? How does someone start that journey, and who qualifies for it?
Yeah, so I would break it down that just before we go into super, that people need to think about the 3 areas of their life that they can hold debt. And from a mortgage broker, we do the debt in these 3 areas. So there's your own name. Everyone knows that straight away. Go to an auction, go buy a house, go put it in your own name, get some negative gearing, which could be a hot topic right now, whether we should have it or not. I reckon we should. Then the next area that people think about more commonly is the self-managed super fund. It's a very out there term. Then the third area of investment that can be good, bad, or otherwise, depending on what your goals are, is the companies and company trusts. So those 3 areas are where we can hold debt. And if we build all 3 of those areas effectively, we'll be able to manage a borrowing capacity for the long term. We'll be able to separate borrowing capacity. So the true separation of borrowing capacity is your self-managed super fund to your own self. None of the 2 meet. So that's a way to manage borrowing capacity there. You might only have $1 million of borrowing capacity in your own name, and your super fund could have 500 to $1 million itself. So you can then get 2 million, which means you could technically say that you're going over the borrowing capacity cap, but you've got 2 separate areas. Companies and trusts can come into it about your long-term play. You might have the play for legacy. You might have the play for how you want to distribute money in the future. You might have the play of how to manage my borrowing capacity and have flexibility in lending from construction, offsets, all this construct equity, all that stuff that super may not, or your own personal end may not either. Or you might want to go to your personal end where the property might be a little bit more growth and negative to be able to get some tax benefits. So those 3 areas are the areas we hold debt, and a lot of people know about their own name. Some more people are knowing about their super, but the trust area is still a growing piece for people to understand how that works for their own situations. Super is good where you got a long horizon depending on your age. You have it is a larger deposit and it's a larger interest rate, but it's a good run. Like, it can be a set and forget. Super doesn't eat, sleep, drink, have a credit card, go shopping. It's one of those areas that, yes, rent is a major component of it, but you can spend a little bit of your super contributions to hold the property as well for the future. It's a little harder to go to multi-property in super, but it is an area that can affect your life. You sort of got your employers putting your super in, or you're putting your super in, and as you go down the path of, you've got your first property, and then you could go down 10 years or even 20 years, and you never know what's going to happen with that property if you've got the right one. And also, what's better than an investment property with a home loan on it is an investment property without, especially when you go into retirement with renewable income.
Yeah, that's true. And I think that's where people are starting to see it's like super can either sit there inactive until you retire, or if you get the right the right people on your side, like an advocate and the right financial advisors and brokers by your side, you could turn that super into something much more stable.
The big thing about super too is that none of the major banks are in there. So if you're it comes back to where a broker really helps someone, is that we have all the non-banks to be able to be in our head. And when you go into the bank, and beautiful relationships with the bankers, and if you want to go direct to the bank, go for it. But if you want to get into super, they can't really advise in that area. Like, there's been a lot of development. Like, when the major banks came out, yes, we had a crushing of like how many lenders we had for self-managed super funds, but now I'm counting 11, 12 that we can go to with differing policies, competition and rates to be able to go after.
Yeah, makes sense. And it kind of leads me into, this next part. Like, what's the number one thing that you think borrowers tend to, overlook that, holds them back later, like when you're trying to grow a property portfolio?
I think we touched on a little bit where we get emotionally involved in the house first, or we've got a contract on the table and we're seeking out information that we want to try to implement ourselves. So the biggest problem I've found with a couple of clients recently is that they take a bit of information, they expect it to be yesterday, they go off, they fail, and then they come back to me, and then we have to get it done in a little bit shorter of a time than the time I was preparing it in the first place. So I see that a lot. I am contemplating whether that's a good marketing strategy, just to give people information, go off and they fail and they have to come back to me to get help. Probably not a good one, but it's an interesting observation I'm seeing at the moment is that people do want to do it themselves. I tend to give a lot out to make sure that people understand what we do, and then let them be. So what you need to do is let the brokers let people be the expert. If I was going to come to a client for that is a nurse and I'm not a nurse anymore, I'd expect them to know what they're doing and I'd let them do it. If you're coming to a broker, yes, I want to understand, the client needs to understand what we're doing, but let them do it. And sometimes it's going to take a bit longer and sometimes it's not. And that's where I'd say is that give it time. Don't go after a property first. Get the finance organized first. That's the biggest thing.
Yeah, 100%. I think that's solid advice. Like if you're going to engage a professional, let them do the role. I think we all have a tendency that we want to take control because it's so hard to give control away when you're the one you've put all this, like, I've saved for 3 years, 4 years, I'm so worried. But it's like, this is why the professionals exist, because if you could go and apply for your own home loan in 2 seconds and get it approved and it's all easy, happy days, which I'm sure some people have tried to do or have done successfully in different parts of, going through to their bank directly. But the benefit you get with a broker is you're actually getting a full landscape of your financial journey, like not just from a property portfolio or owner occupancy, but you're actually looking at, let's look at the big picture. And I like what you do is you're looking at the whole the whole goal set. It's like, where do you want to be in 5-10 years with this property, with other properties? Do you want to do property investment or not? Are you going to keep this for 10 years and we're going to have to worry about it in 10? What's the goal? So I think that's super important.
Yeah, like I love goals. We still have a lot of people that come and instruct us. No, I want to do it that way. Just do the transaction. That's fine. Whatever brings you joy in this process, right?
Yeah, exactly. And I think it's just being flexible to the consumer's needs, but it's like, try and lean into what the professional can give you, because then it unlocks so many opportunities down the track.
And the cool thing is that we've been clients. Like, I've had to go for a loan. I don't know whether I make a good client or not, but I've had to go for a loan, right? So you've gone for a loan. So everyone's gone I've felt it from both aspects.
100%. I think we all do it when we go through the journey. We're probably the easiest ones at the targets to hang on a minute. No, I'm going to control this situation, and then I'm going to shut up.
Well, I'm writing up my own servicing calculators before I need to hand it to the right channel, right?
Yeah, that's what I need to do. I need to call you first.
Yeah, there you go.
And look, coming to, I think one of the things I wanted to chat about today is, the most common mistakes. We kind of touched on this a little bit, but the most common mistakes that you're seeing clients make before they come to you, like what are they, and how do they fix those things, like before they even start?
So I don't think any mistake is able to be fixed. The biggest mistake would be not doing anything.
Okay, yeah, true.
Right? And then there's just minor little hiccups, I could say, along the way. Like if you've bought half a dozen properties in your own name and maxed out your borrowing capacity in your own name, as I said before, we got 3 different areas of borrowing. You may have to think about what types of properties do I want to hold. You might need to offload some. You might need to restructure some debt. You might need to get the things down. So the more common ones are cross securitization is a big one in the residential space that can lock you up. So where is your equity? Sometimes we don't know where it is. So tidying that up so you have control over that. That's a really cool thing. The other one that I've found is that people love listening to things like rent vesting. And rent vesting can be positive or bad. We've had clients that have their owner occupied. It's worth $1 million. They've got 300 grand owed on it. And they turn themselves into rent vestors. And now they're spending $1,500 a week on rent when their $300,000 mortgage was significantly less. So I would agree, rent vesting's good, but what are the circumstances you're in? Paying more on the rent than you're going to get on the property that you're converting is probably where the problem is, and understanding the borrowing calculators on that. Just expecting that when you got approved before that you're going to get approved again. That's another one. With the same bank. Not using more than one bank. That's a very common one. I've gone to NAB or CBA and they can't give me any more. No, I don't think you can do it. So the the thing with more than one bank is that you're going to get the competition between the banks. So that could be on interest rate, which most people think it's interest rate, but it's not. Interest rate's probably one of the last competitions that they go after. It's how they're assessing your income. It's how they're assessing the new debt. I've got a client at the moment that they want to refinance everything, but we can't refinance everything to our bank. We have to keep something with our one bank and put some with the other bank. Otherwise, they can't refinance. So utilizing how, like, we've got lenders that if you have interest-only repayments, they'll just take the interest-only repayment. So if you had that loan on principal and interest, you probably may not get the loan. So there's a couple of little things there with utilizing the policies that the other banks have, because they can't just compete on rate. They've got to compete on how they give you money and how they assess things. So one of the biggest things, cross-securitization, using only one bank, using only one structure like yourself, and not thinking about the other areas that you can invest to keep you going. And the other biggest problem I'm finding is that I've got to draw the goal out of people's heads about what they want to do. I just want to buy an investment property because that's what Mary and Joe did down the road, or Billy and Bob over there got a commercial property, I need to do that. Or no, parents told me to buy an owner occupied, so I'm going to do that. So that not expanding on what you want is hard. Is it a passive income? Is it a legacy play? Those sorts of things.
I think those are really solid tips, to be honest, because I hear those, I've seen those play out in many different scenarios. So I totally hear what you're saying. And I think for, our listeners, if any of you fall into that category of, get clear on your goal. I think that will often drive a much clearer, all your decision points. It'll be much clearer and easier for you and less overwhelming if you can get that.
Oh, one other one is that the loan that you get to get the property doesn't have to be the loan that you have for the life of the property.
Interesting. So you don't have to be locked into that one bank forever.
That's right. So there's the extremes, and then there's the management of your lending as you go forward. So the extremes are, don't have my tax returns, I'm a self-employed person, and I've got that example I mentioned before, the $600,000 block of land contract on the table. It should be worth 150 grand more because that's what it was a little bit of time ago, and we don't know the circumstances that the client was selling, but we don't have the tax returns. So let's do a low doc loan for the loan. And then once we've got the tax returns, we'll flip it back into a standard loan. So that's an extreme. Or the other one is that you've run out of interest only, you've taken 5 years, the bank you're currently with won't give you interest only again. And if that's part of your strategy, then we can refinance you to another one to be able to manage that repayment strategy and what you're doing with your property too. So the loan you have now doesn't have to be the loan you have in the future.
Nice. I like that a lot. And I think people, can understand that. I think this episode's been awesome. We've even gone over time because I'm just enjoying the content so much, because I think we've just really unpacked so many important aspects of this journey, especially with what they're getting with someone like yourself, Aaron. Like I said, this is a very different episode to the caliber that we've had on. And I really think our listeners will appreciate it, because we've gone into so much of the preparation that goes behind it, how to get there. But then we've also talked about, the during process, like applying all the scenarios that you need to be aware of, whether you are investing or owner-occupied properties. I think, to sum this up, I want to go back to one thing. You're in New South Wales, as we've discussed earlier. You've talked about some of your clients in different scenarios. What's some of the stuff that you're seeing? There's a lot of hype in the media at the moment. What are some of the things that you're seeing in the New South Wales market with the housing prices and also interest rates?
Yeah, I'll start off what I'm seeing. We see a lot of investors and some first-time buyers. We're seeing a lot of our first-time investors with the lower budgets going to regional New South Wales and then slipping into Queensland and into Victoria. From a New South Wales point of view, we are seeing a lot of attraction down to Victoria for a lot of the investors as well. I'm seeing some of my Victorian clients want to get out of Victoria. So everyone's got their own little take on things. But from a lending point of view, we primarily focus on investors. So we're doing a lot of refinances and a lot of purchases, even when the rates are high. So when people with the media hype and stuff, there's always a section that's going hard. the hard runs at things. There's a section that's sort of okay, and then there's always a section of the market with lending and property that are going great guns, no matter the weather, the political environment, and all that stuff. So we're sort of in the middle, and the people wanting to buy property, which we still help out some of the people that are having trouble. So we see a lot of purchases. We're seeing a lot of uptake in lending. It's a bit hard for me to say what the market's doing, because in the last 12 months, I've scaled my business up to be able to do more lending, which probably puts me a little bit of an anomaly to say what the market's doing, because I'm pretty excited about what the market's doing, especially if you got the right property in the right place with the right lending on it. So yeah, we're seeing a lot of clients buying Queensland, New South Wales, regional, and Victoria in South Australia. Over the last few years, we've seen a bit of a quietening down there was a lot of hype, everyone's buying in WA, and then we're sort of seeing a little bit more in different areas at the moment, and some really interesting commentary about different other states around. But from a lending point of view, most of the time, for most postcodes in Australia, we can find a solution for people to get that loan on that property and help with their cash flows and going forward.
Nice. No, thank you for that update, because like I said, I'd like to get a full picture, and we get so many Victorian guests, so when I get someone from a different state, I'm like, well, tell me about what you're saying, just to give another perspective as well.
The first home buyer market, I'm seeing a lot of traction to Queensland at the moment because of the land and house at 800 grand and getting 30 grand of incentives. And for all players at home, 30 grand on 800,000 is 3.75% of your deposit. So if you need only a 5% deposit, mortgage insurance, no stamp duty, the government's pretty well giving it away. But just be careful with a $800,000 mortgage. It's nearly $1,100 a week in repayment. So if you're renting for less, you might have to think about first-time investment. Then first home buyer, it might have to think about that. And then in New South Wales, different strategy for first home buyers, which are different. So it's all a little bit of attraction about this first home buyer, own the property for a few years and then convert it into investment as well, once you meet all the requirements you need to.
Well, Aaron, thank you so much for your time today. I'll wrap up with one final question. What is someone who's listening who's maybe feeling stuck or unsure if they can even get a loan? What's your top piece of advice to help them take the next step?
Yeah, top piece of advice. If you feel stuck and you've got that inkling that you might just need a little bit of information about what your specific circumstances are to a bank or to a bit of a lending strategy. It's really just have a conversation. Find a good investment savvy broker, or even cheekily come to us and we can have a good conversation and find out what we need to do and what doors could be open, and then go through it, see what we can find.
I love it. Sound advice. I would definitely recommend speaking with Aaron for those listeners. Where can they actually reach out to you?
Yeah,
jump on.
So the best way is to go to Strategic Mortgage Brokers with an S on the end.com.au. If you hit the contact us page, one of my staff will be in touch pretty quickly. When you submit that form in, you can answer a few questions, or you can just submit your details in, and then you'll get into our world pretty quick from there.
And just to confirm, you also service nationwide, so it's not just New South Wales.
That's right. So we look after customers all across the country. We found it funny when all the East Coast was buying the West Coast. We found the West Coast buying some of the East Coast. So we've got clients everywhere in every state and territory.
I love it. This has been so informative. I've thoroughly enjoyed it, and I'm sure our listeners are going to get so much out of today's episode. I think you might get a few phone calls and a few bookings, because I certainly think I might book myself in. And, but no, honestly, thank you so much for your time and for sharing those insights. And like I said, anyone who wants to get in touch, we'll put all those details to get in touch with Aaron and his team in the episode description below. So please get in touch. And thank you once again, Aaron, for being here and for everyone tuning in.
No worries. Thanks for having me.
No problem. Now, don't forget to subscribe, share, and like our channel if you want more content like this. And to follow on Aaron's journey, we've got his social media links below. You can get in touch and you can follow along his journey. And we'll see you next time on the No BS Real Estate Podcast. Thanks, everyone.
That's a wrap for this episode of the No BS Real Estate Podcast, powered by Abodey AI. If you found this conversation helpful, don't forget to subscribe, leave a review, and share this episode with someone who might need it. If you're looking for more guidance on your home buying journey, you can visit www.abodey.com.au for expert advice, property insights, and the tools you need to find the right home with confidence. If you're already on your journey, you can also download our app, Just search Abodey AI on the App Store or Google Play. Have any questions or want to connect, you can follow us on Instagram at abodey.com.au or send us a message. We'd love to hear from you. Thanks for tuning in, and we'll catch you in the next episode.